adjust that down for obvious reasons. Okay. And I can just see the shard there, just in the corner of my eye, which is even more impressive than the sun, I think, and probably a better analogy. Now, just thinking about your comments on disruptions and connections, and I was thinking about it in the context of what we're trying to do at WPP, and as a thought, actually, when I think about how we try and position WPP with yourselves and others, with clients, with media owners, and indeed our own internal group, which is now numbering 160,000 people in 110 countries. When I think about what we're trying to do, we're actually trying to do cause or deal with disruption, but cause disruption actually as well, and at the same time connect. And actually, if you think back 60 years ago to the 1950s, and you walked into Berkeley Square, where J. Walter Thompson used to be, JWT used to be. It's now in Knightsbridge Green. But if you walked in there, you would have walked in and you would have seen the creative department, the planning department, because Stephen King, who's no doubt the father of planning. I mean, lots of people claim to be the father of planning, but he was. And you'd see the planning department, you'd see the creative department. But you'd also see other departments. You'd see the public relations. You would have seen Lexington PR, which is now Hill and Knowlton and separate. You would have seen BMRB, British Market Research Bureau, which is now part of Kantar and separate. And you would have seen an operations research department, interestingly, which is the department which, would you believe, designed the Mr. Kipling's cake factory. The way that came about was that JWT were working for the company that I think was ABF, Associated British Foods, that produced cakes, and they had this dough, and they didn't know what to do with the dough, so they came up with the idea of Mr. Kipling cakes, and the operations research department actually laid out the design and floor plan of the factory. So the full service agency that JWT represented in the 50s, and the 60s, when television was coming to the fore, was actually a multifunctional agency of quite diverse proportion. And because then it embraced television, having embraced radio and newspapers and magazines and outdoor before. So in a sense, the change that we're going through, that's at a time of great disruption, because TV was a great disruptor, just like the web has become a great disruptor now. What it's resulted in, I mean, the WPP, I would say the agency of the 21st century is still a full-service agency. But the difference is that we've started to build much more specialized pillars. And if you said the analogy was trying to put a sort of top or pediment on top of pillars, sort of a Greek temple analogy, we're building much stronger pillars on which we're trying to build a strong roof, rather than have weaker pillars, which I think you had in the 50s and the 60s at JWT and others, on which you tried to put a strong roof, with the analogy developing into the top falls down because the pillars are not strong enough. Because what happened in the full service agency of the past was the creative department, and increasingly the television creative department, was paramount. They were the people who got the corner offices, the salary increases, the bonuses, the Ferraris, etc. No longer the case, I have to say. But they were the people who got that. And what happened was that people who were underappreciated, it started with the media departments, the planning and buying departments, started their own companies and started them separately. So you got this sort of functional building, and we're seeing it also with digital. I mean, I was reading a little blog, not a particularly good blog, I think, by somebody this morning. It was very long and turgid, actually, which went on about the fall of the independents, or the absorption of the independents, and referring to, example, our investment in AKQA most recently, and why this was happening. And I think they got it wrong, because what that's about is that the independents are finding it increasingly difficult to leverage their scale and build scale geographically. I mean, they build a position in a city or a country, but going beyond that is quite difficult. So actually, the disruption and connection thing is quite interesting in the context of what we're trying at WPP. What we're trying to do is to build very, very strong specialist capabilities, on top of which we try and connect people connect clients in a singularly unique way. And what clients want actually is they don't care about where the talent comes from. They don't care, for example, in the advertising industry, whether it comes from, in our case, JWT or Ogilvy or Y&R or Gray or United, or in media, whether it comes from Group M or Mindshare or Mediacom or MEC or Maxis. What they care about is getting the best people on their business. And that'll be a little bit of a theme. So anyway, I meandered a bit, but I just thought, on the basis that, and it does show that at least I'm thinking about what I'm going to say. I did think, as I was talking about, it was quite an interesting, I found it interesting anyway. You probably found it extremely boring. But anyway, never mind. Let me just say, I'm going to talk a little bit about what our strategy is in the digital area in a second. But I want to make sure you understand that, we look at the world currently through sort of what I would call 9 lenses. There are sort of 9 things that are going on. I'm just going to refer to them very briefly, which we think really determine, one of which is the web, obviously, and the implications. And, Kantar Media Compete is a good example of what we're trying to do, and Scott and his colleagues are trying to do with Eric at Kantar and beyond. And it just reminds you that Kantar, WPP is about $17 billion of revenue this year, supposedly. If I include the associates, that's companies that we own 20% to 49% of, it's 21 billion. So 100% of those. So a little bit of a cheat, but it's directionally right. 4 billion of that comes from consumer insight. So data and the application of technology to our business is absolutely fundamental. It's probably the biggest point of difference. Scott sort of talked about our digital strategy being different, which I think it is, but it is the biggest point of difference between us and our narrowly based competition. Defining our competition as the advertising and marketing groups, an Omnicom, a Publicis, an IPG, a Havas, a Dentsu, or whatever it happens to be. I mean, it's not in the context of a Nielsen and an Ipsos and a GfK, because obviously data and technology are important to them too, or more broadly to some of the consulting companies or even technology companies that are increasingly going into that area. But there are 9 things just to sort of, and again, I will mention them extremely quickly. I'll try and restrict it to one sentence very difficult for me to do, but I will try and do that. One sentence for each. The first is globalization, move to East, South, and Southeast. And it's not just Asia, it's Latin America and Africa and the Middle East. The second is that we're faced with overcapacity in almost all industries. I mean, I did a session in Paris this week with Renault-Nissan, actually. And, the automobile industry, despite the demise or potential demise of the big 3 in Detroit, two of which, not our client Ford, but Chrysler and GM, that had to go to the government for aid. Despite the demise for that, there is actually probably more physical capacity now in the automobile industry than there was pre-Lehman. So the need for differentiation is critical. And the converse of that, in a sense, is that the shortage is human capital. If you look at all the demographic statistics, won't bore you with them, you see that what is increasingly becoming apparent is this shortage of human capital and shortage of talent. So if we think we have a talent war now, stand by. The third is the web. You get disintermediated. Google, at the heart, I think, of Sergey and Larry's and Eric's strategy is disintermediation of various established businesses and breaking down the tyranny of geography. So you get disintermediated. You get disintermediated by a low-cost business model. And looping back to the talent point, young people like to work in less bureaucratic, faster-moving, high-tech companies. So they're attracted. They are a source of talent attraction as well. Fourth point, or fourth lens, is retail power. Growth and development of companies like Walmart, like Tesco, like Carrefour, are putting enormous pressure on manufacturers. And if you ally that to their lack of pricing power at the point of contact with the consumer, and the rise in commodity costs, although that's ameliorated in the last few months. But if you look at it over the last 5 or 6 years, commodity costs have risen sharply. That's put tremendous pressure on margins. And that has changed the behavior of manufacturers. I'll come back to that in a second. Fifth point is the importance of internal communications. Trying to communicate strategic and structural change internally is probably more important than externally. Sixth point is organizations are more global, but they are becoming more local. What's getting squeezed inside organizations is regional structures, because technology is enabling global and local to communicate much more effectively and quickly. The seventh lens is, and it's related to this point about retail power, is that the result of that pressure from retail, lack of price inflation at retail level, not at commodities, rise of commodity prices and squeezing on margins, has meant the rise of finance and procurement. Finance and procurement have risen in relative to marketing, in my view, too far, but I would say that, wouldn't I? But it's really got out of control. And very interesting, the guy who runs PIMCO, Mohammed Al-Zarian, yesterday was saying, look for pressure. He's a bear on the markets at the moment, and he was the guy who said, we should go on strike and not buy US Treasury bonds. He's the biggest, I think they are the biggest bond fund in the world, basically. Anyway, what he said yesterday was, we're going to see more revenue pressure on companies in the third quarter and beyond, and they can't cut costs more. They've already cut costs. So their ability to cut costs, and this ties in with something that we've been saying for years, and Jeremy Bullmore, who used to be the chairman of JWT, has continuously and much more eloquently described, is that there's a finite limit to what you can do in terms of cutting costs. Whereas on the revenue side, it's infinite, at least until you get to 100% market share, if you can get there from a regulatory point of view. But in comparison to what you can do to the top line, cutting costs, and he said yesterday, actually, he doesn't believe that companies can cut costs anymore. That's a pretty definitive statement. I think you can always do better. But what was very interesting was here was somebody who's really a purely finance guy, purely a sort of hedge fund operator, or not hedge fund, bond fund operator, saying the same thing. So finance and procurement in these conditions, the last 20 years when inflation has been pretty much non-existent, when you really think about it, at the retail level, not at the commodity or input level, the rise of finance and procurement probably has gone too far. And the last 2 points are government. Government's here to stay. Don't believe that, despite what's been happening post-Lehman and the attempt to bring down government deficits, that this will remove the government from the industrial sector or commercial sector. If you look at the historical precedent of the 30s, government was there from 29 through to the start of 10 years, through to the start of the Second World War. And I'm not suggesting for one moment that the solution to the problem is a third World War. What I am saying is they're here. If I look at our, it's interesting, you look at our first half year results, the strongest growing sector in our business was government, amazingly enough. Growth in government, at a time when governments are trying to reduce deficits. So it's sort of interesting, sort of sitting where the Conservative Party, I think maybe they're still in this building, it's just interesting to think about that. And the last point is CSR. I don't have to tell you that doing good is good business. It's as simple as that. It's change. There's little or no greenwashing. Doing good is good business. And people have figured out that if you're in long-term brand building, doing good improves the brand both externally with consumers and internally with people. So, as that is background, remembering that's how we see the world, what's our strategy? Well, we have 4 objectives, one of which is related to the digital pillar. The first is so-called, what others call emerging markets, and we call faster growth markets. We think it's insulting to people in China to describe them as an emerging market. They've emerged. It's just interesting to reflect that China is now a $15 trillion market. A $7 trillion market out of 65 trillion. America is still $15 trillion, but China is the second largest market in the world. And I'll just give you a good example, as Renault and Nissan is top of my mind this week. When I was looking at the Renault half-year results, 6 of their top 10 markets, 6, are fast growth markets. They call them emerging markets, but they're fast growth markets. So it's just interesting, this shift in the balance. And in fact, in their first half, their European volumes, Western European volumes, were down 14%, and their extra outside Western European volumes were up 14%. They were even Steven for the first half year overall. Half their business is outside Western Europe, but it dramatically shows you that we live on two planets, really. Planet no growth, which is roughly where we are at the moment, not totally, because the UK is a slight outlier, and planet growth, which is epitomized by Jim O'Neill's bricks and Next 11. So we're at about 30% of our business, so 30% of that 17 billion or 21 billion is in those fast growth markets. We want it to be 35 to 40. There's no sort of miracle to that number, 35, 40. In fact, if I was honest about it, what you'd really want is almost to have all of your business in those fast growth markets, because that's where the growth is, that's where the delta is. The problem is that clients wouldn't let us be totally focused on those markets and ignore the slower growth markets, such as Western Europe. And just one observation, it's always dangerous to go with the flow. So just think what Carlos Slim, who's probably one of the two strongest, most successful investors in the world, is doing. Carlos Slim, running a Mexican or South American company, is borrowing Japanese yen and Swiss francs at close to zero interest rates and investing in Western Europe in KPN, the Dutch telecoms company, and Austrian Telecom, which yield about 9, 10 or 11%, I think it was. So he's playing the reverse yield there. And when questioned about whether that was an intelligent thing for a Mexican company to be doing by his investors, he said, I haven't done badly, come back in 10 years' time and we'll see who's made money. But it's just interesting. Buffett has said the same thing, that he sees Western Europe as being a growth opportunity. And each of the big private equity companies, so Rubenstein at Carlyle, Schwarzman at Blackstone, and Kravitz at KKR, have all said the same thing, that Western Europe offers exceedingly good opportunities. So maybe we, over the next couple of years, remember each of those 5 economies, UK, France, Germany, Italy, Spain, each of them is about $2 to $3 trillion. So together, they're about, let's call it 15, 16 trillion, so as big as America. So in the context, even though they're slow growth or no growth or down, absolutely they're still there. So you don't ignore them completely, but as I'm looking for the delta in terms of top line growth, those fast growth markets are critical. New media is similarly now 32% of our business with AKQA, and we want it to be 35 to 40%. Again, no magic to that number. It isn't a sort of an inflection point. It's just directionally where we're going. It could be, I suppose, 50%. It could be even more. And there are those who argue, I think, quite accurately, that eventually, just like with television, starting in the 50s and the 60s, that television got melded into the agencies in a singular fashion, that digital will too. And when we try and calculate that 32% of our business digital, so 32% of the 17 or the 21 billion, it's very difficult to actually calculate it, because where does digital begin and where does it end? So that the whole thing is becoming fused in a much more basic way. The third part of the strategy, consumer insight, is really about 2 things. One is that quantitative disciplines or data should be an integral part of our business. I mean, one of the blessings of digital is it enables, as you know from Kantar Media and Kantar Media Compete, is that you are in a much better position to measure. We haven't effectively delivered that yet to our clients, but we're getting close to. I think Kantar has been in the vanguard of that, but it deals with that famous quote that everybody claims that they came out with about, I know I waste half my advertising, but I don't know which half. That it's really about data, but it's more importantly, I think, about the application of technology to our business. And this is a big point of difference. I mean, we fundamentally believe that we are sort of evaluators, independent evaluators for our clients. Now, I know that we have representatives of the new technology companies in the room, But the new technology companies, to my mind, are actually new media owners. They're not purely technology companies. And therefore, just like a News Corp, just like a Time Warner, just like a Disney, just like a Viacom, just like a CBS, they have a vested interest in their own channels. And what we have to do is to act as a purveyor, if you like, or an analyst or an independent agnostic arbitrator of where it's best to spend the money we invest on behalf of our clients and where. So we manage $72 billion of media investment, both digital and legacy, around the world. Our role is to determine whether that 72 billion is the right figure. Should it be more? Should it be less? And where it should be distributed. And let me sort of comment a little bit about where we see digital spending going, because the numbers are very interesting. So out of that 72 billion, News Corp would be about 2.5 billion. Last year, we spent with Google about 1.6 billion. This year, we will spend with Google, I think it will be well north of 2 billion, probably 2.3. With Facebook, we spent about 200 million last year. We've talked about a budget this year of 400 million, which is accurate. Whether we get to that level or not, I don't know. But you see the difference between the two. And the reason that Google has been, I think, so successful and will be so successful, and we've been bleating about this for must be a year, 18 months, and you can see, actually, interestingly, the response in the Google share price, which has gone up about a third, I think, in the last 3 or 4 months, as people suddenly have started to understand the dynamics of what is happening in the marketplace. Google's great strength is it's in search, it's in display, it's in video, it's in social with Google+, and last but not least, it's in mobile. And of course, Motorola mobility gives them a great opportunity. So you're seeing dynamic changes. Just to give you points of reference, AOL is about 400 million, Yahoo, 500 million, Yahoo's about 400 million. So those are the points of reference. So Google actually could become our single largest media owner in our media portfolio in a relatively short period of time and with tremendous growth. And just one other observation, Facebook to me, and they don't like what I say, but I will say it again, because I think it is true and becoming true in terms of what you see in terms of market performance. Facebook is a tremendous brand builder. It is not an advertising medium. Certainly they haven't managed yet to discover that advertising medium. So if you come away from this thinking that WPP knows what it's doing, or Kantar knows what it's doing, or Kantar Media Compete knows what it's doing, and write something on your Facebook page to your friends along those lines, that's great for our long-term brand building. However, if you're searching for an agency in one way or another, or a research company, or a digital company, and you're searching on Google or Bing for that matter, or anybody else, the whole thing is a different part of the journey. And I think it's understanding that that's critically important. And I think that is a reflection of what's happening with Facebook post its IPO, its market value, et cetera. I think actually, to be honest with you, I think just Facebook should relax. This is a marathon, it's not a 100-meter sprint. And the pressures that build up on a company because it IPOs at 25 times revenue are apparent for all to see. They should just relax, build their business over a long period of time. They are the third largest nation on earth. They probably will be the largest country on the planet in pretty short order. So those are some of the dynamics that we see as we build 35 to 40% of our business in new media and consumer insight. And just one further point on the application of technology. We have already, through the Xaxis platform, built a proprietary media planning and buying tool online. We think that's absolutely fundamental. That we as agencies, as purveyors, as analysts, as advisors, should have an independent platform that advises clients where they should spend their money. And the last point is the uglily phrased horizontality. What horizontality means is that clients are not interested in agency brands. Now, this offends a lot of my colleagues, particularly those who are responsible for running the brands, a number of whom are in the room, but but here goes. The reason is what clients want is the best people working on their business. They actually don't care where they come from. We care. And the best way of describing horizontality is we are building structures that clients want, not that we want. That's what we're really about. And again, I'll come on to that in a minute. And it occurs at two levels. One is at a horizontal level across the whole of WPP. So Ford, our biggest client, Satish Corday, runs an agency called Team Detroit, which is 6 agencies we've fused into one, including digital. And each of those agencies has a shareholding in that agency, and it's a seamless structure. It's not the BS that you read about in the trade press, where people talk about putting teams together, and they're not really. They're just sort of people that come together in a room just to make a presentation, just win a piece of business and the implementation. This is actually a seamless entity, which does work. Now, it's quite controversial, and it's quite difficult to implement, but it's something that we're increasingly doing. And interestingly, when Procter, about 2 weeks ago, put Gillette into review, which must be probably the biggest brand review that we've seen in our industry for a long period of time, it did not issue the RFPs to agency networks. It issued the RFPs to the incumbent parent, Omnicom for BBDO, Publicis Group, not Publicis, Wieden & Kennedy, which is a single agency network, and WPP, not Gray, which is our agency that works primarily with P&G. So it's just interesting that clients are starting to get their mind around that, and that's becoming more and more important. So just putting it very simply, just to remind you, new markets are about 29% of our business now. New media is 32%. Quantitative is about half our business, defining that as digital and consumer insight. And where we want to be tomorrow, we want at least a third of our business to be in new markets. We want 35 to 40% to be in new markets, 35 to 40% in new media, and quantitative is roughly where it should be at 50. Now, there is some lap over between the two. It's actually about 7%. So you can't add what we have in digital at 31% or 32%, including AKQA, and the 29% we have in new markets, and say that's the total. There's about 7% lap over, and that will become increasingly important. Now, there is an important thing here that's going on. Mobile will be the driver in the fast growth markets. I mean, the numbers are quite extraordinary if you think about it for a minute. China Mobile is now up to 650 million, 700 million Chinese consumers on their mobile network, single network. There's about 950 million, I think, in total in China, 650 million of which are with China Mobile. In India, market's slightly smaller, about 850 million users. 3 networks, Airtel, Vodafone, and what's the other one? Airtel, Vodafone, and Reliance, each over 100 million. Mobile really leapfrogs the PC, and it's the cheap form of access to the internet, and therefore what you will see over time is this lap over and this sort of Venn diagram will become increasingly important. Now, on new media, there's little slowdown that we can see in the predicted growth of digital advertising spending. Historically, from 6 to 11, it's been about 18%. It's slight amelioration in 11 to 17, but it's projected at 15% compound. So if you think about WPP in the first half of this year, excluding currency and acquisitions, we grew at 3.5%. Digital actually grew for us about 8-9% in the first half of this year. You can see that we're getting significant growth, greater growth, in the new part of our business, the new digital part, apart from in comparison to the legacy part. Now, in terms of our digital strategy, what is it? Well, firstly, it's obviously digital everywhere. We want all our businesses, through training and recruitment and acquisitions, to build their digital business. But it sort of falls into 3 different buckets. There are the traditional businesses, like a JWT, a Y&R, a Gray, an Ogilvy, which have traditional strength in TV-based, let's call it, advertising in the 30-second, 67-second commercial, who we are encouraging to embrace digital in a more and more aggressive way. So you've got your sort of legacy companies that you're trying to change and change the base. So this is not dissimilar to free-to-air television companies, or take the most extreme example, newspaper and publishers who've had the most difficulty in accommodating the change to digital and getting them to change their base. There's a second bucket, which is what I would call our digital companies. So that would be a Wonderman, an Ogilvy One, a G2, a VML, a Possible Worldwide, where we're trying, an AKQA now, where we're trying to get them to build their digital capabilities, and I'll come on to this again in a second, even more aggressively. And there's a third area, a third bucket, which is where we make investments, where we can sometimes acquire 100% of that investment, but more likely it's a buddy media or an Omniture, where we take a small equity position with a heavy emphasis on training. Prior to Adobe and Salesforce.com acquiring those two companies, and from our point of view, both those acquisitions probably took place too early. What we were doing, and what we continue to do, is to train large numbers of our people on web analytics, and indeed on the power of Facebook and other social media inside our organization. So there are three things that we're doing, and that's encapsulated here: digital everywhere, building specialist expertise, for example, web development, DSPs, etc., establishing a proprietary technology platform in data and technology like Xaxis, and then partnering with what I call the new media owners, Google, Microsoft, Facebook, Apple, and Twitter, to build their companies. Now, one name that's not on that slide, which is really important, is Amazon. I don't know how much time you're going to spend on e-commerce, but I was struck by just an experience that I had in America and Europe in 1 week. One of my favorite questions, in fact, probably my favorite question to ask anybody is, what's the thing that worries you most? What keeps you up at night, and when you wake up in the morning, do you worry about? I'm talking about professionally, not personally. And so I was talking, I won't say which company, to a big retailer in America, in middle America, which covers a lot of potential retailers. And I said, what's the, he said, Amazon, straight out. And I said, why? Well, disintermediation. And he said, also, Jeff Bezos doesn't have to worry about quarterly earnings like I do. And he can, dunk them for a couple of quarters, which he's in the process of doing at the moment. Again, so then I moved on to let me call it a transportation company, and a little bit further south. And I said, what worries you? And he said, Amazon. He said, Amazon gives us big opportunities for transportation, particularly when new products are introduced, but on the other hand, it causes great problems. And the third one was even more interesting. It was a packaged goods company. It's actually based in Europe, not based in London, so that narrows a bit, but based in Europe. And I said, what worries you most? And there were about 13 or 14 people. It was our annual sort of top-to-top, as they call it, evaluation. And I said, what worries you most? I said, does Amazon worry most? Because I've had 2 experiences in the last week where people said they didn't. They said, no, it doesn't. And then the CMO said, no, hold on a second. It's our 49th biggest customer, and it's growing very, very, this is a very big company, and it's growing very rapidly because it actually distributes and supplies. There's a component that this packaged goods company produces, an important component, and he said they are becoming more important, and it does worry us. So this disintermediation at the retail level by companies like Amazon is a big issue that the manufacturers have to deal with. And in a way, you could say that's why a Procter, for example, invests in a company like Ocado to understand what it is. Now, new media gives us, in the agency business, the institutions always, investors always ask us, is this disintermediating you? Is it a lower margin opportunity? Interestingly, if you compare traditional advertising with search and display or mobile and social media, there's more opportunity for us in the darker blue box. In the traditional media, we've taken 12% as it used to be 15. In Mad Men days, in Don Draper days, it was 15 plus 17.65% on production cost, which was 15% of the gross. we've just taken roughly what we think it is about now, which is about 12%. If you move into search and display, the opportunity for the agencies is around 15 to 20%. And of course, you get into mobile and social media, the creative and production opportunities, content opportunities are even stronger. So we see this as being enhancing our opportunity, not just from a growth point of view, but indeed, I have to say, from a margin point of view as well. And that's why the share of digital revenue has grown so rapidly from us, from 12% in 2000 up to 31, 32%, including AKQA now, and we're targeting that 35 to 40% that I mentioned. In terms of our digital assets, we're very proud of the fact that Forrester lists 7 digital leaders. We have 4. Wonderman with revenues this year of about 950 million. Ogilvy 1 with revenues of 900 million. AKQA, which has just joined the group, and this year will do about 260 million. And VML at 150 million. So those 4, plus G2, plus the whole slew of offers we have inside Group M, including Xaxis and 24/7 Media, and indeed Possible, are our digital assets. And you can see that we're up to a third, roughly, of, as I said, our 17 billion of revenue. Now, the new markets are also obviously an important part of it, and we've added organically, we've added strongly. And I should just say, our business in China is $1.3 billion, of which 200 million, you can see from this slide, is in digital. We have 14,000 people in Greater China, about 2,400 are in digital. In China, you can't find acquisitions. It has to be done organically. And if our Chinese business is growing at 14 to 15% currently, so call it 15 to make the maths a little bit easier, and it's 1.3 billion, you're adding about 200 million a year. That cannot come from acquisitions. It has to come organically. But in China, that doesn't stop us from picking up 1 or 2 smaller operations. Brazil, similar issue. We're growing at 15 plus in Brazil. Have some wonderful digital assets like FBiz there, and Casa and iCherry, which we've added. But we're adding by acquisition. But the primary growth is coming through organic growth. India, where we have a 50% market share overall, again, digital is playing an increasingly important role. Russia, where we're smaller, we only have $250 million of revenue, which 50 is digital. Acquisition opportunities like Grape are far between, but there are a few. But the point is that Russia, the BRICS, plus the next 11 are increasingly important in terms of what we're trying to do. Now, in terms of data, I said it's about data and the application of technology. The explosion, this is I have no idea what a zettabyte is. Neither do I know what 1 trillion gigabytes are, but it looks good. And it also says it was small and it's getting bigger and more important. But I would just say one thing which I think is really important, has impressed me, and I'm naive in these areas, so I'm easily impressed. But I think it really is impressive. Our ability to sort of harmonize and bring together data. People talk about big data and you ask them what they mean, and it's very difficult for them to explain what it is. To my mind, what it simply means is just pulling together all the data that our clients currently get from us and indeed other providers, and providing it in a much more usable, online, real-time basis. And the things that we're doing in a thing called the Data Alliance, which Nick Nyan and David Spitz are leading, and Eric and others, Eric Salama and others are heavily involved in, is really a massive opportunity. And what we're looking to do is to dig deep vertically with a number of clients in order to build that big data capability, because that really is the opportunity on data. Information is no longer power. Marginal cost of information is 0. There's a fixed cost, I guess, somewhere, but the marginal cost is 0. It's the ability to interpret it in meaningful ways that is critically important. So in summary, before I ask you whether you've got any questions, if we've got any time left, what do we see the opportunities and our advantage? Well, marketing clearly is becoming much more data-driven. Interestingly, one client said to me this week, is new media a scam? Because they meant, because when they got into new media, they were told by their media agency, which is not ours, by the way, that they would spend less on media overall with the growth of new media, and what they're finding is they have to spend more. Well, I would argue that with fragmented audiences, it's likely you would be spending more. However, over time, as we understand those audiences and targeting more clearly, it may well be less. And that's, I guess, that's that point about if we're investing 72 billion, can we get the yield on that up? Should it be a lower figure, or should we distribute it in a different way? Or indeed, should it be a higher figure with much greater efficiency? Clients need better utilization of existing data and simplification, and help in managing the explosion that diagram showed, those red boxes. Digital campaigns are driven by analytics, but you need feedback to shape these new activities. And we have to be in a position to provide you and clients generally with continuous updated data for real-time use and decisions and reactions. And we think finally we have, as we would do, but I think we do have actually, in fact, a unique combination of assets, not just in the traditional areas of legacy media, but in new media, in new markets, and in consumer insight. Thank you very much.